Hi, I'm Isaac, and today I'm discussing borrowing costs. Now, what is borrowing costs? Borrowing costs has to do with interest and other costs incurred by an enterprise in connection with borrowing of funds. So when an enterprise goes in to borrow funds, the interest cost and other related costs incurred in obtaining the funds is what we call borrowing costs. Now, examples of items that go into borrowing costs include, like we said, interest on bank overdrafts and other short-term and long-term borrowings. 2, amortization of other costs incurred in connection with the arrangement of borrowings. 3, we have finance charges in respect of a finance lease. So when you acquire an asset on a finance lease, the interest you pay on that finance lease or in financing the asset on a finance lease basis is also part of borrowing cost. Then 4, exchange differences arising from foreign currency borrowings to the extent that they are regarded as an adjustment to the interest costs. From an accounting perspective, borrowing costs that are directly attributable to the acquisition, construction or production of a qualifying assets. So qualifying assets are supposed to be added to the cost of the assets. Now, all other borrowing costs are supposed to be recognized as an expense. So all other borrowing costs are to be expensed as and when they are incurred, right? So apart from borrowing costs that are related to qualifying assets, which will be added to the cost of the assets and be capitalized on the statement of financial position, all other borrowing costs are supposed to be expensed. Now the question is, what are qualifying assets? A qualifying asset is an asset that takes a substantial period of time to get ready for its intended use or sale. Now, that could include PP&E, property, plant, and equipment, and investments properties during the construction period. It could also include intangible assets during the development period. So it includes intangible assets during the development period. Then 3, it could include made to order inventories or other inventories that take a substantial period of time to bring them to their saleable condition. Now, we mentioned earlier on that borrowing costs that are related to the acquisition of a qualifying assets should be included as part of the cost of the assets to be capitalized. Now, capitalization, when should we commence capitalization of such borrowing costs? There are 3 conditions that must be met before capitalization can be commenced. 1, capitalization should commence when expenditures are being incurred. Then 2, when borrowing costs are being incurred. So 2, borrowing costs are being incurred. And 3, when all the activities that are necessary to prepare the assets for its intended use or sale are included. So activities that are necessary to get the assets or to prepare the assets for its intended use or sale are in progress. Once we commence capitalization, we would have to continue capitalizing until we probably get to suspend capitalization. Now we may suspend capitalization during period in which active developments are interrupted. So during period when active development is interrupted, and that is when we can suspend capitalization. Apart from suspending capitalization, we may also cease capitalization. Capitalization should cease when one, substantially all of the activities necessary to prepare the asset for its intended use or sale are completed. So for instance, if it is a building that you are constructing, substantially the building is now ready for occupation. If it is a plant that you are constructing, substantially the plant is ready for its intended use. If that is the case, then you will have to cease capitalizing. 2. Where construction is completed in stages, which can be used while construction of the other parts continues. So there are certain assets that can be completed in stages. If that is the nature of the assets, then the portion that is completed, any capitalization that is related to that particular portion would have to be ceased. However, the portion that is still under construction, we can continue capitalizing in relation to that particular portion. For the purpose of illustrating the accounting treatment for borrowing costs, we'll use the information that appears on your screen currently. From that information, we are told that we are borrowing funds for the purpose of constructing an item of plants. Now, when was the funds obtained? We are told that the loan date, so loan date is on 1/1/2015, 1st January 2015. The project itself commenced, so commencement date is on 31st March 2015. Then the project actually completes, so completion date is on 31st December 2015. Now these dates are very important because they also defined the period within which we capitalized our borrowing costs. From when we looked at the conditions under which borrowing costs can be capitalized, we saw that there are 3 different conditions that must be met. One is that expenditure on the project must be incurred. 2 is that the borrowing costs should be incurred. And 3, the activities necessary or required for the project to be commenced must be in progress. If we look at this, even though we obtained the loan on 1st January 2015, we didn't start the activities or we didn't start spending the amount until 31st March 2015. What this means is that the 3 conditions, one of them is not being met. So we can't start capitalizing until 31st March 2015. We obtained an amount of 1 million cedis, right? And this one is specific for the project, so we call it a specific loan. So we have a specific loan of 1 million cedis, which was obtained on 1st January 2015, purposely for the construction of our project. In addition, we also have some other loans, which we normally call the general loans. Of the general loans, we're told that there is one that is 1.5 million cedis, so 1.5 million cedis, which is at an interest rate of 18%. Then there is another one, which is 1 million cedis, which is also at an interest rate of 14%. Now, these 2 loans make up the general pool of loans that the company have. What is going to happen is that if our cost of the project is more than 1 million, then the excess funding will come from the general pool. So what this means also is that any expenditure on the project will first have to come from the specific loan until we fully exhaust the specific loan. After that, any extra expenditure will be taken out of the general loans. Now, from a computation perspective, since the specific loan has its own interest rate, we are going to use the interest rate for it. In our illustration, we are told that the interest rate for the specific loan is at the rate of 15%. So 15% for the specific loan. When it comes to the general loan, we have two different rates. To determine the rates that will be used in calculating the interest for the funds that will be coming out of the general pool of loans, we are going to calculate what we call the weighted average rates. Weighted average rates. Now, the weighted average rate is calculated by applying the various interest rates on the respective loans and then calculating the weight of that. So, for the first loan, it is 1.5 out of the general pool times 18%, which gives us 270,000. Then there is 1 million at 14%, which gives us 140,000. So what we'll do is that we'll sum the total interest, which is 410,000, and also sum the total loans in the general pool, and that is 2.5 million. The weighted average rates, right, WAR for short, is calculated by taking the total interest, so total interest divided by the total loans, of course in percentage, so multiply by 100. So in our illustration, it's going to be equal to 410,000 divided by 2.5 million times 100. And this gives us 16.4%. So the weighted average rates that will be used in applying any funds we would take from the general pool of loans would be at 16.4%. The specific loan is coming at a rate of 15%. So what it means is that if I spend any amount from the specific loan, I'm going to calculate it at a rate of 15%. And if I spend any amount coming from the general pool, I'm going to apply a rate of 16%. From the illustration question, we're also told that there was some investment income arising from investment of the specific loan. So we have to calculate the investment income. We're told that we invested 400,000 at the rate of 9% for 2 months, so 2 divided by 12. So this gives us an investment income of 6,000. Now this investment income of 6,000 will be netted against any specific interest coming from the specific loan for the purpose of capitalization, because the funds that was used for the investment came from the specific loan. Now to derive the total amount to be capitalized, the total borrowing cost to be capitalized, we first would break the total borrowing cost into the one coming from specific loan and the portion that is coming from the general pool of loan. So let's look at first the specific loan. Now for the specific loan, we started actually spending the amount on 31/3/2015. Because even though we got a loan on 1st January 2015, we didn't start spending it until 31st March 2015. So we would take our 1 million loan obtained, multiply it by 15%, and this one will be running for only 9 months. It will run for only 9 months because we are starting from 31st March 2015. So this gives us an amount of 112,500. Now of this 112,500, there is also an investment, so investment income, which is the 6,000 we computed here. It will have to be taken out of it, so minus 6,000. So that gives us a net amount of 106,500. So we have 106,500. Then, since we are done with the specific loan, we will now go on to our general loans. We know that any amount that is used out of the general loans would have to attract a rate of 16.4%. On 31st March, we actually spent an amount of 600,000. Now, this 600,000 can all be said to have come from the specific loan. So it means that on 31st March, we didn't use any funds coming from the general pool of loan. On 30th June, we spent an additional 800,000. Of the specific loan of 1 million, we only spent 600,000 on 31st March, meaning we still have 400,000 more to spend. So what this means is that the 30th June amount of 800,000, 400,000 came from the specific loan and 400,000 came from the general pool of loan. So when we come to the general loans on 30th June 2015, we say we spent an amount of 400,000. But we know that any amount spent out of the general loan would attract an interest at the rate of 16.4%. And since this amount was actually spent on 30th June, it means that it will only run for 6 months. So we'll multiply this one by 6 divided by 12 because we are only using it for 6 months. Now once we do that, we will get our total amount. When we apply the computation, it gives us 32,800. Then again on 30th of September 2015, we spent another amount. In this month, we actually only spent an amount of 300,000. Again, this 300,000 is coming from the general pool of loan, so it is supposed to attract an interest at the rate of 16.4%. So we multiply this one by 16.4%, and it is going for only 3/12. It is going for 3/12 basically because we spent the amount on 30th September 2015. This gives us an amount of 12,300. So for our general pool of loan, we split it between the amount or the dates on which the amounts were specifically spent. Putting the two together, we get 45,100. 45,100 is the total amount that is going for the general pool of loan. 106,500 is the total amount that is going for the specific pool of loan. So we put the two together, that will give us 151,600. So what this tells us is that the total amount, of borrowing cost to be capitalized is 151,600. So we are capitalizing 151,600 of our total borrowing cost for the year. The borrowing cost to be capitalized, which we have as 151,600. One would also ask how much of the borrowing cost will be expensed then. Now to determine the borrowing cost to be expensed, it is logical to look out for the total borrowing cost for the whole year, and out of that you deduct the borrowing cost to be capitalized, which is the 151,600 from it. Now, to calculate the borrowing cost for the whole year, we'll have to first pick our specific loan. Specific loan, an amount of 1 million was obtained at interest of 15%, which gives us 150,000. Then we also need the general loan, the interest on the general loan. Now, I wouldn't need to recompute this because I did the computation earlier when we're calculating the weighted average rate. We calculated 18% on 1.5 million, which gives us 2.7, and then or 270,000. Then 14% on 1 million, which gives us 140,000. Putting the two together, we have a total loan or loan interest of 410 on the general pool of loans. So I just bring my 410 here and sum the two, which will give me 560. Now 560 is total borrowing cost for the year. So for the whole 12 months, our borrowing cost is 560. Out of this 560, we have capitalized a portion. Now how much has been capitalized? Even though we have 151,600 here as the amount capitalized, this 151 is net of an income of 6,000. So to get the correct amount, we have to add back the 6,000 to the amount here. So the actual amount to be deducted from this, so amount capitalized would be, instead of 151,600, it would be 151,600, add back the 6,000 income. So that gives us 157,600. So I'm going to deduct the 157,600 from it, and we'll be left with 402,400. So what it means is that the 402,600 is the borrowing cost to be expensed, that is written off to the income statement. So of our total 560, we have capitalized an amount of 157,600, and then we are writing off 402,400 to the P&L. That is how you do the split between borrowing cost to be capitalized and borrowing cost to be expensed.